If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Italy economic stagnation Q2 describes a period in which the economy shows minimal growth, elevated labor slack, constrained investment, and persistent structural burdens, with the second quarter exposing how these factors combine to limit momentum. In Q2 2025, Italy's GDP annual growth rate rose by only 0.4% year-on-year, according to preliminary data, while the quarter-on-quarter change was a contraction of 0.1%, a rare instance of negative quarterly growth in an economy that has for years hovered at very low expansion. These figures confirm that the economy is barely advancing, dragging broader potential and reinforcing stagnation. The unemployment rate was approximately 6.0% in March 2025, one of the lowest recent readings, but still elevated relative to an economy with near zero growth and aging demographics. The youth unemployment rate and long-term unemployment remain higher and underpin structural job market fragility. The key interest rate context is shaped by the euro area policy floor. Although Italy does not set its own maximum policy rate, the prevailing European Central Bank main refinancing rate of about 3.75% in mid-2025 serves as a base for domestic financing costs. In a weak growth environment, high real interest burdens for firms and households reduce investment and hiring. Italy's inflation rate stood at 1.7% in May 2025, down from earlier months and among the lowest in the euro area. This modest inflation reflects weak demand and limits the real income improvements that could drive consumption, thereby reinforcing stagnation. On the fiscal side, Italy's debt-to-GDP ratio has climbed to approximately 135% of GDP, with projections toward 137% by end 2025. This extremely high debt burden constrains fiscal capacity and limits the margin for large-scale policy responses amid stagnation and unemployment. Taken together, the indicators define the stagnation framework: negligible growth, moderate unemployment, constrained financing, low inflation, and very high debt. Italy in Q2 illustrates the symptoms and syndromes of stagnation. Italy's economy is stagnating with very low GDP growth of 0.4% year-on-year and 0.1% quarter-on-quarter. Consumption has stagnated, investment remains subdued, and the export sector is under stress. While the unemployment rate is around 6%, youth unemployment is much higher, and low inflation dampens real income gains. Perhaps most constraining is the debt-to-GDP ratio at over 135%. This limits budget flexibility for stimulus or job creation, reinforcing the cycle of stagnation. Italy's economy is showing minimal growth, with the second quarter of 2025 exposing how these factors combine to limit momentum. GDP grew just 0.4% year-on-year and contracted 0.1% quarter-on-quarter. The unemployment rate is approximately 6.0%, but this masks deeper issues like high youth unemployment and structural fragility. Low inflation at 1.7% reflects weak demand, while the debt-to-GDP ratio is climbing towards 137%. This creates a difficult policy environment. With the ECB's key rate around 3.75%, borrowing remains costly. High debt severely constrains fiscal stimulus, limiting the capacity to lift growth and reduce unemployment. The margin for maneuver is minimal. Looking ahead, the outlook remains weak, with growth forecast around 0.6% in 2025, rising to just 0.9% in 2026. Absent structural acceleration, Italy risks its period of stagnation becoming entrenched. In Q2 2025, Italy's economy contracted by 0.1% quarter-on-quarter, with annual growth at just 0.4%. Unemployment hovers around 6%, while low inflation of 1.7% reflects weak demand. With debt climbing towards 137% of GDP and the ECB's base rate near 3.75%, fiscal policy is severely constrained. This signals a cycle of stagnation, with forecasts remaining weak through 2026, as the economy lacks momentum to reduce unemployment or improve incomes. Taken together, the indicators define the stagnation framework: negligible growth, moderate unemployment, constrained financing, low inflation, and very high debt. Italy in Q2 illustrates the symptoms and syndromes of stagnation. First, the very low GDP growth of 0.4% year-on-year and the 0.1% quarter-on-quarter indicate output is not sufficiently expanding to absorb labor, raise productivity, or generate dynamic investment. consumption stagnated as household spending was held back by weak real income growth, precautionary saving and limited wage pressure. Investment remains subdued, business fixed capital formation continues to struggle with weak domestic demand, regulatory uncertainty and cost pressures, so large-scale expansion or hiring remains rare. The export sector, long a strength for Italy, is under stress from global headwinds and the euro's relative strength, reducing the positive impulse from net trade. With demand weak, firms postpone hiring and capital expenditures, labor markets slacken, and growth ebbs. The unemployment rate of approximately 6.0% may appear moderate compared to some peers, but in the context of almost flat GDP, it reflects the buildup of idle capacity, unused labor potential, and weak job creation. Youth unemployment in Italy, at roughly 18 to 20%, and structural mismatches in regional labor markets mean that even in a quarter of modest headline unemployment, deeper unemployment problems persist beneath the surface. Because growth is so low, labor markets cannot generate sufficient new jobs to absorb entrants or reduce underemployment, making the unemployment rate a persistent drag. Financing conditions also play a role. Real interest rates are positive once inflation is accounted for, so borrowing remains costly for firms and consumers. With output weak and financing constrained, investment and hiring are delayed further, feeding into stagnation. Low inflation at 1.7% dampens wage growth and real income gains. If inflation had been higher, households might see real wage improvement, assuming nominal wages rose, and demand could strengthen. But in Italy's case, demand remains weak, reinforcing stagnation rather than triggering a demand-led rebound. Perhaps most constraining is the debt-to-GDP ratio at over 135%. High debt means a large share of government revenue is already committed to interest and principal servicing, limiting budget flexibility for stimulus, structural investment or job creation programs. With fiscal policy constrained, the capacity to lift growth and reduce unemployment is limited. Structural reforms are necessary but slow-moving. In the short term, the debt burden both reflects and reinforces stagnation. In sectoral detail for Q2, the contraction in industry and agriculture weighed on GDP. Both sectors recorded negative value-added changes quarter on quarter, while services were flat. On the demand side, domestic demand excluding inventories contributed positively, but net exports contributed negatively. Exports down by 1.7% year-on-year, imports up by 2.5%, highlighting external headwinds. These patterns imply that the sluggish growth was broad-based rather than confined to one sector, making the labor market impact more pervasive. Firms reported weaker order books and postponed hiring, particularly in manufacturing and construction. Meanwhile, consumer sentiment remained depressed and hiring in services stalled despite unemployment not yet surging sharply. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed. Stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.